Good day, fellow investors. It's winter here, and what better to do in winter than to analyze stocks? Now, one of the most commonly asked stocks for me to analyze is Markel Corporation. Is it a little Berkshire where you can put your money in? So in this video we will discuss it, analyze it, stock price overview, business overview, fundamentals, valuation and investment conclusion. If you like this video, also the comparison with Berkshire, that will be a topic through the video. Please ensure that like button, and if you really like the video, please share the video and make others reinsure that like button. Thank you for supporting the channel. So let's immediately start with Markel's stock price overview. When it comes to long-term investing, you always want to see this. So this is more than 100 baggers since inception, so did really well, which means that it is a compounding machine. And more interestingly, if we look at the market capitalization, it's just $17 billion. If we compare it to the 604 Berkshire, there is a lot more room to run here. So you can expect another 50 bagger if this is baby Berkshire. Over the last 5 years, the stock didn't do much, especially compared to other investment portfolios or even the market, so it might be a good time to see whether there is value hiding there. Plus, if we look at the price-earnings ratio, of course there is accounting behind it, but 7.16 makes it extremely cheap, and probably one of the reasons why I get a lot of questions to analyze Markel. The current CEO and investing manager for Markel since 1991 is also a chapter here in the great book that we discussed that I really urge you to read, and I'll also put the link to the video for this book in the description below, so you can check this book, very interesting book about investing, after this video is done. Another note on the stock, it doesn't pay a dividend, just like Berkshire. It reinvests in new businesses, but comparing to the S&P 500 or the Dow, it didn't perform really well over the last 5 years. So let's see the business and see whether this is now really cheap, given the underperformance and given the low price-earnings ratio. When it comes to investing in businesses, if you want to learn more about a business, I always urge you to go to the annual report. There is always a clear description of the business, especially in the risk section, so always go to the annual report. And as Markel is promoting themselves at Baby Berkshire, there is always an interesting, let's say, letter from the CEO. But let's start with what is insurance, and this is from Warren Buffett's letter to shareholders. Simply put, insurance is the sale of promises. The customer pays money now, the insurer promises to pay money in the future if certain events occur. Sometimes the promise will not be tested for decades. Think of life insurance bought by those in the 20s. When insurance is not tested, you get float, which arises because premiums are received before losses are paid, an interval that sometimes extends over many years. During that time, the insurer invests the money. This is Berkshire and also Markel. And then just a ratio to know, the combined ratio represents total insurance costs, losses incurred plus expenses compared to revenue from premiums. A ratio below 100 indicates an underwriting profit and one above 100 a loss. Important to know when looking into insurance businesses. And if we look at the combined ratio for Markel, it was 91%. So that is good. 101% in 2020, but of course that was because of the situation then. So nothing wrong there, positive insurance. However, the cost of float is determined by our underwriting loss or profit, and because loss costs must be estimated, insurers have enormous latitude in figuring their underwriting results. So we always have to take into account those results with a pinch of salt. However, since Berkshire's float has cost them virtually nothing over the years, because the combined ratio is better than 100, it has in effect served as equity. So the same with Markel, that has the positive combined ratio. But when it comes to insurance, there are 4 concepts, and you can pause the video here to read it so that I can go faster, but many insurers pass the first 3 tests and flunk the 4th. Be willing to walk away if the appropriate premium can't be obtained. So in the insurance world, there is always something to insure. Ajit Jan spoke about insuring Elon Musk's rocket to Mars, and then his answer was with Elon or without Elon in the rocket. That's a question for insurers. So will you walk away from the deal? Everybody else is making money by insuring everything, real estate, this and that, and you are not because it's too risky. So that's always a risk, and it's very hard to estimate when it comes to investing in insurance businesses. Therefore, I prefer avoiding analyzing or investing. But as you asked, here we are. Going deeper into the business, we have the insurance, we have the float that leads to investments and Markel Ventures, so like Berkshire, stock market, and investments and other businesses that they are growing. For example, in 2020, they acquired a controlling interest in Lansing Building Products, VSC Fire and Security, so they are building that portfolio. If we look at Markel's last 13F, and if we look at the portfolio, the largest position is BAM, so also very requested stock for me to analyze, so I'll do that next, which will be then a factor here for also Markel. But Berkshire, Google, Amazon, Disney, and if we look at the exposure of the portfolio, it's not that big. So an extremely diversified portfolio. We have spoken about diversification, you might want to check that video out. However, there is also Haggerty, which is a recent SPAC acquisition where they acquired something, and this valuation is based on the price they paid for the business and the valuation they paid, which is, let's say, concerning because they acquired Haggerty, the insurer of old-timer cars or whatever they do, and the deal would value Haggerty at 3.13 billion, which means that they will put into their books what they paid for that business. The real value of the deal will be seen over the years. So that's something we have to see in the future, whether this market value based on what they paid will be real. Let's go next to the financials. We have insurance segment profits. 2020 was a bit slow, 2019 better, 300 million. Reinsurance, they are losing a little bit there, but let's say they make 200-300 million based on insurance. And the current environment for insurance is really good. Investment segment profit, this is a profit accounted for if the stock prices of these stocks go up. As all these stocks went just up and up, then you have a huge investment segment profit, but that's just accounting. Markel Ventures segment profit, they make about 250 million per year. Then there is also interest expense. I don't know if they account it only for the whole holding company and not here. If then do, then I'll have to change something in the valuation which will lower it. But okay, let's see first and then see with and without. You can play around with the template later. The combined ratio for the company is mostly positive, still some issues with reinsurance, but that's a difficult business, so as long as there is float, it should be good. But you never should expect a lot of profit from insurance. It's mostly about the float. Net investment income from that float is about 284 million over the first 9 months of this year. Over the last years, of course, low interest rates, but around 400 million if you focus just on that. Now we have to see whether to deduct the 170 million from interest costs from holding debt. Then when it comes to investment gains, they calculate the yield. So investment yield is very low, 2.4%, and then they calculate the price of the stock market portfolio that went up, and then they calculate it in the yield. This can go down, this can go up. This is something that Warren Buffett calls shenanigans and bad accounting, so I would not account it as value, but this trickles down into the price-earnings ratio, and therefore this PE is mostly due to accounting and not real profits. We'll have to adjust for that. Then we have Markel Ventures, so total equity is 1.6 billion. There is a lot of goodwill, 900 million, so they are buying businesses way above book value, so something to keep in mind. But okay, I guess that is modern times. EBITDA, net income 160, maybe the 2020 was a little bit so-so, now they invested in more, so let's say 200 million going forward. And now we come to the little red flag where I can't say that Markel is comparable to Berkshire, and that is interest, cost, and debt. If we look at Markel, and if we look at the cost of debt they have, you can see that it is 6.25, 5.35 that they used, and then 7.125. Those are extremely high interest rates. This is high yield debt. Now, they issued 5%, which is better, but this is still above, I think, high yield debt. And if we look at the high yield, which is junk debt, then we see that Markel is issuing bonds at higher than junk debt. So they say they have great ratings, but the market doesn't give them money cheap. If you compare that to Berkshire, look at this at the first page of the annual report. You can see the notes there, Berkshire, the trading symbol. So for the next, what is this, 40 years almost, 2.65% for 40 years. 20 years, 0.5. This is when you have rating and trust. When I compare to these, then they don't have it, which means this is one big warning and can't be compared to Berkshire. This is much higher risk. Plus, if you are Berkshire, you never need money. You are always rich on cash and money. And in May 2020, in the biggest crisis, you issue 600,000, 6% fixed rate preferred shares. So you can buy Markel with a dividend yield of 6% if you are in this game. And then they raised 591 million, which even increases this 6% by the costs that are payable here. So they needed money in the worst times in the last 100 years, which means that there is something interesting and much different than Berkshire. Or they're taking much more risk, so they invest and take money, but issuing capital at 6% in the current environment, that's already an interesting bond you can acquire. So apart from that, let's make a valuation. So I feel there is much more risk than when it comes to Berkshire. Berkshire is financial fortress. Markel, we don't really know. And if they issue capital, I also read in the annual report that also some subsidiary issue capital. So that is always, okay, why are you issuing capital if you are a financial fortress? Then you never do that like Berkshire. When it comes to valuation, we need real net income and the future growth rate, of course. I assume 200 million of profits from insurance, even if that is a little bit questionable because we are now in great times for insurers. Let's say ventures, another 200 million that those bring in, and let's say that stocks, the portfolio is 8 billion, with these price-earnings ratios, let's be a little bit positive, and let's have stocks add 400 million of value from that investment. Total 800 million. If we deduct 200 million of interest costs that are really high, as we said, high-yield bonds, then we are at 600 million. I have added this to my intrinsic value template. This template and all other publicly analyzed stocks you can download for free in the link in the description below. You can also play around with the template. You can also check my video on this template and intrinsic value calculations. I have put net income in billions, 800 million, 0.8 billion. They don't pay dividends, so no value there. If they grow at 8% per year over the next 10 years, this is big growth, so this is really exuberant. But still, if I expect a 10% return and then have a 20 multiple on the net income, which is higher than what they have now, only then for a 10% return I get an intrinsic value of 12 billion. The current market cap is 16-17 billion, which means that the return will likely be lower. And here we are. You can expect, if all things go well, the return to be around 6% per year. But they really have to grow really good. If there are issues and the net income is 0.6 billion, as we have changed that, the growth rate is 6%, which can be even lower if there are bad times. Terminal multiple 12 on the cash flow that we have seen with Berkshire, then the present value is, let's say, 6.7% on a 6% return, but then the expected return will also be 10%, so then even 5 billion. So there is a potential for a 75% decline very easily here. And if they have to reach for capital, then it's very ugly. And also, if we compare it to Berkshire, you can see Berkshire here being the orange one, it outperformed the company over the last 5 years. So for the investing conclusion, Berkshire, let's check the template then. If we go back to here, let me find Berkshire, here it is, and using earnings per share in this case, Berkshire is a little bit overvalued now for a 10% return, but it's better priced than Markel still. So I would go for Berkshire, especially if it is a financial fortress and we don't know whether the risks taken by Markel are really there. And immediately the CEO says about the great return he had over 31.75 years, where he says that when you get to 31.75 year time phrase, I would argue that the noise fades away and that you're left with substantive fundamentals. But there is one noise that I feel I must argue with him, and that's this one. 1990 interest rates went from 8% down to 0%. So this is a huge tailwind, and if you take more risk, you will beat the S&P 500. And he did beat the S&P 500 by just 100 basis points per year over 30 years. So this is not a miracle, this is maybe also luck. This kind of noise we'll see when this reverts. Buffett showed amazing skills here, buying on the cheap. He keeps Berkshire as a financial fortress, not issuing capital, ready to accumulate more when these times in the cycle come again. I don't know whether Markel will be there when these times and bad insurance times come again. So I'm not going to follow Markel because it's too risky. I prefer Berkshire, but if you are invested, I hope I have given you some points on what to focus when it comes to investing. Thanks for watching. The price of my research platform is going up, where you have all my core analysis, portfolios and everything, so check it before the end of the year. Thank you, and I'll see you in the next video.